Question 50 asks us to calculate the diluted earnings per share for SW. So in this case, if we look back through the example, it tells us that the company has convertible instruments that have been in issue throughout the entire financial year. The liability component at the start of the year was 5 million and is being measured at amortised cost using effective interest rate of 6%. Conversion of the instrument would result in an additional 1.2 million ordinary shares being issued. At the start of the question, they've told us that the basic earnings per share has already been calculated at 30 cents by taking earnings of 3 million and dividing that by the weighted average number of ordinary shares of 10 million for the year. The only other bit of information in the question is about the corporate income tax rate, which is 25%. So there are a few things to think about in this, but if we think about converting between debt and equity, the difference with debt compared to equity is that we would be paying interest, and that interest is not only deductible from profit but also reduces the profit for tax purposes, whereas dividends are a distribution out of our retained earnings. So if we talk about converting part of our instrument into a liability, or from a liability into shares in this case, that would mean that there would be an interest saving. So in terms of calculating the diluted earnings per share, the first thing we need to do is calculate the adjusted earnings as a result of the conversion. So the basic earnings figure that we used for the basic earnings per share calculation was 3 million. What we need to do is add back the interest which would be saved as a result of the conversion of these instruments. So on $5 million at a rate of 6%, we could calculate the interest that would be payable. But remember that with a tax rate of 25%, the overall effect on earnings would actually be just 75% of that figure. So for the purposes of the diluted earnings per share calculation, we would have an adjusted earnings figure of 3.225 million. However, the other thing to bear in mind is that converting this debt into shares would actually increase the weighted average number of shares. So in terms of the shares, we did have 10 million, but it says here conversion of the instrument would result in an additional 1.2 million shares being issued. So to calculate our diluted earnings per share, we're going to take this adjusted earnings figure and divide it by this adjusted shares figure. In this case, if we do that and round our answer to one decimal place, we should get 28.8 cents.